Hello, everybody. Welcome to this episode of Road to Retail podcast. We appreciate you joining us today. And Bruce, why don't you tell our audience who we have as our guest today?
Will do. Thank you, Tracy. Folks, today we're joined by Andy Whitman, founder and managing partner of Loft Growth Partners. Andy, thanks for coming on the show. Welcome. And why don't you tell the folks a little bit about your background, what your firm does, and how you got doing what you're doing?
Sure. Thanks for having me. So I started the first almost 15 years of my career on the operating side of CPG, what used to be General Foods when it still existed. General Foods eventually bought Kraft. Multifunctional background. I started as a marketing kid, moved into roles that were sales, ops, finance, innovation, a little bit of everything. And in large cap CPG, Kraft, P&G, L'Oreal, pick your favorite large CPG company. They're really good at hundreds or thousands of things. I observed, not surprisingly, they're not great at maybe two things that are of most note. One of which is they're not ideal at the $0 to $100 million phase. And related to that, they're probably not the most patient in the world, especially as public companies. Separately and similarly, I got exposure in an unusual circumstance to what at the time were probably the three most leading private equity firms that were really focused on CPG. Now, remember, this is like 25 years ago or something. And all three of those firms still exist. They're great firms. But I also had an observation there in that they weren't doing smaller companies. They weren't investing in smaller companies. So interestingly, the observation on both the corporate side and on the investor side was, they needed a bit of a feeder system. So why not me? Crazy idea. And 23 years later, we, Loft Growth Partners, are the longest tenured investor in emerging branded consumer products. So that's sort of how I fit into all of this and how Loft fits in. As a side note, not a commercial for Loft, but we invest in businesses that are real businesses, just real small. At a minimum, a couple million in revenue, most of them sort of 5 to 20 or 25 of revenue. And typical first check is often, $2 to $5 million. We've done much larger, we've done much smaller, but that's most typical. So that gives you a quick snapshot.
Oh, thank you. That's an impressive background. And when you were talking about the big companies, I guess you said it nicer about not patient. I mean, sometimes just trying to get innovation through the quote unquote stage gate system, you just keep killing things because they don't show that they're going to be big automatically and move the needle on companies that are big.
I think that's fair. The big companies are sometimes, and I mean this in the best sense of the words, they're sometimes too smart for their own good. Most of the really big innovations in the market, not all of them, but a lot of them, the big companies knew the need existed, but they just couldn't nurture it along. So it wasn't going to turn out to be Swiffer or Lunchables in its first or second or third year. It was going to take a decade to get to $1 billion or 200 million. And that's not really good for public companies generally.
Right. Tracy?
Yeah, so Andy, let's talk about the process or checklist that we call it, that a small emerging brand should go through when they're starting to think about raising money. So what things should they think about?
Well, I think the first thing to think about is do it for the right reasons. Don't do it because you think you should, or all your friends are doing it, or you read about it in the press. Do it because it's the right thing to do. And this will come off as a weird thing for me to say, given what I do for a living, but too many people raise too much money too early. I'm sort of in the business of doing that. So discouraging people from doing that sounds a little weird, but I can tell you, most entrepreneurs look back on the crazy mistakes they made. And even second and third and fourth time successful repeat CPG entrepreneurs still talk about obvious mistakes they made, obvious with hindsight as a judge. And the only thing I can almost guarantee is every entrepreneur is going to make mistakes. And if you have a lot of money, they're expensive mistakes. And if you don't have a lot of money, they're cheap mistakes. So don't raise too much too early. Figure it out. And when you think you've got it more figured out than not, then add more fuel to the fire. Just because everybody else is raising, a $5 million seed round, that's a lot of money in CPG for a really early stage business. So don't raise too much too early.
Good advice.
Which might be a segue to a topic we were talking about offline, which is, what do investors want to hear, right?
Mm-hmm.
I think they want to understand, what are they looking for? It's all about a reason to believe. Now, the reason to believe is different if you're Aunt Susie that's investing in your niece or nephew's business, because you're really investing in him or her, which is different from an individual investor's definition of reason to believe, which is different from my reason to believe definition, which is different from P&G's reason to believe. So as your business gets bigger, more sophisticated, you're further along the curve, you're raising more money, the definition of reason to believe is different, but it's all about reason to believe. I think that's the most important phrase for investors and entrepreneurs.
So just to clarify that, and I love that reason to believe, that's a great way to look at it. So when looking, as an investor, how important rank these as the idea, the innovation, the background of the founder, what kind of intellectual property do they have? Like, how does that all roll up?
Well, let me take IP off the table, because for the most part, branded CPG doesn't have a lot of IP.
Yeah, good point.
There's some, but not a lot.
Right.
I mean, there was a technology around how to get the crust to rise for the very first time when you bake it, as opposed to it's pre-cooked and basically a cracker that's topped and you call it a pizza.
Mhm.
So that was a real example of technology, but there isn't a lot of that.
Right.
So if we set that aside, your brand's important, your proposition is really important, but I would take an A team or entrepreneur with a B idea over the opposite, the inverse.
Right.
Because the smart person, the smart team will figure it out. That said, there are some dumb ideas I've seen over the years, but the majority of businesses that fail don't fail because they're dumb ideas. They fail because they run out of cash.
Yep. Yep.
How do you view kind of just following this a little bit, Andy?
Sure.
How do you and your colleagues or other people that you've crossed paths with in your line of work, what stock do you put in the founder? By that, I hear you about good ideas, but if someone's a one-time winner, are you a little more sitting on the edge of your seat, or is every single investment opportunity different regardless of what you've done in the past?
Well, I mean, certainly somebody that has success, probably gets a little bit more attention than somebody that's never done it before, and somebody like, Seth Goldman or John Foraker that have done it repeatedly get a lot more attention. But that isn't the majority of situations. So when we deal with the real world, the vast majority of entrepreneurs are first-time entrepreneurs. The vast majority of people don't do serial entrepreneurs. And if they do, they're not necessarily serial entrepreneur in the same industry. They might be in tech and now they're doing a CPG entrepreneur. We have a business that founded by two brothers in Austin, Texas, called Wonder Belly, that are doing some really interesting things in better for you OTC, which is quite a white space relative to food, which still has lots of white space, but not like it did 20 years ago or something. Anyway, one of them has some tech entrepreneur background, but both of them are first-time CPG entrepreneurs. They're learning and making mistakes just like everybody else. And that's not a comment on them. It's, Seth or John, the two guys I just mentioned, would talk about the mistakes they've made, and that they know what they're doing.
Yeah, everybody makes mistakes.
Oh,
Yeah,
yeah.
and a lot of them are unique to, you know, lighting at retail is horrible. So sometimes, some packaging choices look great in your living room or office and look terrible on the shelf. And again, you learn that by seeing, not by experience.
Yeah, it's interesting that you picked that example. We had Richard Palmer from Little Big Brands, and one of the things he's talked about with packaging in CPG, he said, sometimes an entrepreneur falls in love with their package that was designed by their daughter or niece and looked great at the farmer's market, but on the shelf at HEB, when the lights may or may not be great and the mom has two kids in the cart screaming,
Right.
it's a
I
little
think that's
too.
right. And there are lots of businesses that go from Amazon to Whole Foods or Kroger, and the communication messaging online is much more forgiving than the fraction of a second you're going to get going down the aisle at pick your favorite retailer.
Yeah, you've got that. So Andy, let's talk a little bit about, and you gave a little bit of this in your opening piece on yourself. Talk a little bit about the different types of financing that's available to small emerging challenger brands. You sort of mentioned that sometimes it's an investment in your niece and nephew, but people hear things like friends and family, seed, blah, blah, blah. It'd help to hear it from a pro like you.
Sure. So let me start most broadly. Most entrepreneurs bootstrap their business, self-fund, credit cards, whatever, to a certain point. Now, some have wherewithal to do that a lot further. Some barely have the ability to, go to Kinko's, well, FedEx office, just dated myself, and get 100 sell sheets printed. There's no value judgment on that, but most entrepreneurs will take it as far as they can to a certain extent. Then there's friends and family, which is a pretty common term. People that are really betting on you more than your business. It's not that they're not interested in your business, but they're betting on you. This is Aunt Susie that I just sort of joked about. Then there's angels. Angels is a broad term for individuals that might write $50,000 or $250,000 checks. Maybe they're $500,000, but they're rarely more than that kind of money. And 50 or 100 is a lot of money. Angels will sprinkle their bets. The focus on people that have relevant experiences. My coaching to entrepreneurs, look for individual investors that can help you. Now, importantly, if you want help, we can come back to that later. And then there's institutional investors. We're an institutional investor. We've raised money from our own investors. And the kinds of private equity firms or other institutional investors you read about in New York Times, Wall Street Journal. Now we're small, you're not going to read about us much, but most investors you read about, they're managing other people's money as well as being material investors in their own fund. Institutional investors are not right for the vast majority of businesses. Not because they're not interested, but because the return potential for an institutional investor needs to be big enough to make a difference. And the expectations of, I don't know, time horizon, whatever, aren't matched well to most CPG businesses. It's not a slam on them. It's, there's only a certain number of businesses that are going to get to 50 or $100 million. And there's a fraction, teeny little fraction of the businesses that are going to have a really big exit that makes sense for an institutional investor. There are lots of other great funding sources. And if people aren't familiar with Elliot Began, they should be. He runs a group called TIG Brands. Elliot is an amazing resource. He and I do a lot of collaboration on helping the entrepreneurial ecosystem, but he talks all the time about what do you do for the other, I don't know if it's 90 or 95 or 98% of businesses that aren't right for institutional investors. And there are lots of other sources, and Elliot does a really nice job helping to educate entrepreneurs about that. There's revenue-based financing where companies can do equity but have a chance to buy it back over time, pay back some dividends so the investors can get a decent return. But again, it's not going to be a $200 million exit. There are plenty of businesses that will never get to 10 or 20 million of revenue, but they're really cool, great little businesses that an individual investor can do fine. So again, I went off on a tangent, but people should look up TIG brands. And some of
TIG?
the TIG.
Okay.
Good,
So
good.
Andy, one follow-up before I kick this
Yeah.
back to Tracy. One of the things that we've had inquiries from brand founders and entrepreneurs is, when they do friends and family or angel, the question is, well, how much of my company should I give up? I always tell them to find professional counsel, but my off-the-cuff, cheap Scottish guy answer is as little as possible. But I don't, how do you tell someone who's trying to do the latest, let's pick something out of the sky, orange juice, how much they should give up in a friends and family round?
Yeah, I mean, my first answer is a lot of these friends and family financing should be a convertible note. So it's basically debt that converts into equity when they raise quote unquote real money later. That kicks the valuation topic down the road.
Mm-hmm.
When you have a better insight, because no disrespect meant to a $500,000 or $1 million revenue business, but you're trying to draw a line through a dot and a half. You don't have enough history, broad overstatement. You don't have enough ability to project, is this thing going to be 10 million or is this thing going to be $1 billion? Well, that's a big difference. So if you kick the can down the road a little bit, that's a good thing. Convertible notes is a good option. The other thing is, and it's easy for me to say, and this is going to come off very flippant, but I sort of mean it that way, that it just doesn't matter that much. Let me say what I mean. Let me give an example. Somebody decides to raise $1 and they think their business is worth $6. So post money, their $7 valuation, somebody's going to own 14% of the company or a group of somebody's. If an investor you really like or a group of investors you really like comes in and says, we want to do your $1, but we think the right valuation is $3. They just peed in your pool, right? They cut your valuation from 6 to 3. Oh my God, your hair's on fire. Well, not my hair, but hair's on fire. Well, that means in a $4 post money, the 3 plus the 1, they own a quarter of the business. Respectfully, I would say the difference between the 14% and the 25%, especially split among a bunch of people, who cares? If the business is a good idea, it's going to be worth something. If the business doesn't pan out, it obviously doesn't matter. And mathematically, I can say with a certainty, the number of cases where it really matters is very, very small. So don't get hung up on valuation. If you need $1 to get to the next stage of your business, take the $1 from people you like and get done with your fundraising. Don't prolong it, especially in today's fundraising world. But I've been saying this for 15 years.
So,
Great
so
input.
Andy, before I kick it to Tracy, kind of a follow-up that I think you already wandered into. What should a company look for in an investor? We have some people that say, I know exactly what I'm doing. I just need money. They always kind of make me nervous. People that can help you, people, value added cash, someone that might be good at marketing or have a distribution company. What should the company look for in an investor?
There's absolutely nothing wrong looking for a passive investor that's going to give you money and leave you alone. Absolutely nothing wrong with that. If you're looking for that, know it, be clear with your potential investors, And God bless you. There's absolutely nothing wrong with it. I'm not being facetious. What you don't want is somebody that's what they really want, but what they say is, I want your help.
Right.
First of all, it's really, really obvious to those of us that have been doing this a while, the people that don't really want help, but say they do. It's really obvious. And if you want help, know what you want help with. Different folks can help you with different things. There are people that are social media gurus. There are people that have really deep distribution expertise. And I'm not talking about somebody that owns a distribution company, but people have different towering strengths. Know what you're looking for. If you don't know what you're looking for, you're not going to find it. So having a sense for what you're looking for is helpful. And sometimes it's just, I'm looking for somebody that can help me see around the corner that I don't even know the corner's there. Okay. So you're looking for somebody that's been there, done that. Okay, that's fine. Understand what level of commitment you're looking for from people. There's a big difference between somebody that expects they're going to get half a day of your time and an investor that thinks they're going to give you 30 minutes once a quarter. If you don't talk about it up front, boy, that's going to be an uncomfortable discussion later.
Yeah, what you're saying, Andy, is clear expectations on both parts.
Absolutely. And again, it's really obvious if somebody wants or needs help in certain areas or doesn't. And there's absolutely nothing wrong with any of the above. Just know what you're looking for and be clear with your investors.
How often, what percentage of people, I'm just curious, want help and are willing to accept help though, versus I know it all, just write me a check, I'll check in every quarter. Like, what's the split on people that really want help and accept help? Because we've run into brands like, I got it, I know what I'm doing, I just need a check, or somebody.
Yeah.
Because there are entrepreneurs who think they know it all, right, Andy? And
Yeah.
and
I'd bifurcate into 3 buckets. There's a fairly small group of folks that really don't want any help, just want a check. At least the people I bump into. Then there's the people that want help, but deep down don't know how to internalize it, don't know how to listen, are a little bit less good listeners than maybe they could be. So I don't know, mathematically, maybe it's a self-fulfilling prophecy because we are not passive investors. I would describe as what we do as not being investors. I describe it as industry help that happens to come with a bucket of cash. Very euphemistic, not very fancy sounding, but that's what we do. Right. All 5 on our team are operators by background. So it's probably self-fulfilling. We don't see a lot of people in the first bucket of just looking for capital because that's not us.
Mm-hmm.
Good.
But there's a decent portion of people that really want the help but don't know how to accept it.
Mm-hmm.
And then people that genuinely really want the help and are really interested in the accepting of it.
Yeah, we find that some entrepreneurs are not very coachable.
Oh, sure. But that's not just entrepreneurs, it's athletes, it's everybody, right?
Yeah, that's very, very true.
Personality types.
Sure. Well, let's talk about the process of raising money. So talk to us about, what does a brand need? What kind of reporting do they need to provide? Those kinds of things.
Sure. I'll come back to reporting in a minute, but I think every company, regardless of stage, needs 3 things. The earlier stage you are, if it's a napkin idea, it'll be less quantitative than if you're a quote unquote real business with 50 million of revenue and you're looking to raise 10 or 20 million from institutional investors. But, I think all three need three simple things. First is a one-page executive summary. Keep it short, keep it simple. I haven't mentioned it yet, but I'll mention it now. On the resource section of the loftgrowthpartners.com website, there's a plethora of free resources from entrepreneurs, one of which is a example of a one-page executive summary.
Great.
We borrowed liberally from the Angel Capital Association, but sort of modified it slightly so it was more CPG centric than tech centric. But feel free to take a peek at that. So one-page executive summary, not 3 pages, not 5 pages, 1 page. Second is a basic 10-page, maybe 15-page PowerPoint. Key data, don't hold back stuff, because you'll do it in the second meeting. It's 10 or 15 pages. Don't waste people's time. But it's a simple thought. I'll come back to what I think should be in that in a minute, but it's your story.
Right.
And third is a bottoms-up Excel. Never PDF an Excel model. It's so frustrating. People want to look at how your calculations, if they want to cut your revenue in half, they can do it and see what it does. If they want to add some more spending for oopses, if they want to try and grow faster, let people play with it. And this is bottoms up. It's not, there's a billion people. If we only get 2.5%, it's not top down. This is, I'm going to use a CPG retail example. We're going to be in 200 doors. We're going to sell, 2.2 units per store per week. We're going to have this amount of distribution. So you have a tab on your revenue buildup. Then you have a tab on your discounts and allowances. And you're basically mentally go down the P&L. Each has a tab. Here's your cost structure. We have 2 products initially. We know this one is going to cost us that. This one's going to cost us that. So they have slightly different gross margins. Here's what you think your mix shift is, blah, blah, blah. And I'm not going to go through the whole thing, but, build it from the bottom up. Most of these companies, including ours, have, if you exclude the few number of businesses that have a plant or the few businesses that have a direct store delivery model, if you exclude those, most CPG businesses have 10 or 20 people. And in the early days, it's 2 or 4. List them by line. We're going to add a person in August of 2025, and that person's going to be a $110,000 person, and then you add benefits and bonus. I mean, that's the level of thought.
Right.
And it makes it really easy for people to follow. And then you need to translate your your P&L to cash. Because at the end of the day, cash is king. That's all that matters. And by the way, in the resource section, there's some good discussions that I've done with Gary Hirschberg, the founder of Stonyfield Farms, the organic yogurt, around cash is king. Again, most businesses don't go out of business because they're bad ideas. They go out because they run out of cash. And, cash in CPG is lumpy. Probably in most businesses, but I don't know anything about restaurants or other than I eat out a lot. You can't generally make 2.5 cases. You have to run 100 cases or 1,000,000 cases. So your production's lumpy, that sucks up cash. So anyway, do your cash. So 3 things: 1-page executive summary, a PowerPoint, which I'll talk about in a second, a bottoms-up Excel. So now on the PowerPoint, again, in the resource section, there's a document called 5 Things to Tell Investors. I think those 5 things apply whether you're a napkin idea or a $100 million idea. It's the same 5 things. The level of depth you'd go into with a $100 million business is very different than the level of depth you go into if it's a napkin idea. 5 things, again, people can look at them online. Number 1 is we have a differentiated approach in blank. Ideally, that blank is a large and growing category. But if it's a small category, It's a small, high repeat purchase category. Whatever it is, we got a different approach because nobody wants to hear about the same me too. We've got a different approach to blank. So that's number one. Number two, we're on the right track. We're doing well. Now, what on the right track means if you're approaching launch to market is very different than if you're in the market and people expect a ton of data of here's how we sell at Kroger, here's how we sell at Amazon, blah, blah, blah.
Right.
But again, we're doing well. Number two. Number three, we're just get going in terms of blank. Sales, profitability, margins, whatever. We're just getting cooking. Number four is we're the right people to pull this off. Or in a solo entrepreneur, I'm the right person to get this to the next stage. Again, something about the right person or people. And number five is now's the time to invest in here's what it means for you. Not for me, but for you as an investor. Five simple things. Again, in a napkin idea, this is probably 2 pages for a couple of them and 1 page for a couple of them. In a $50 or $100 million business, I've seen this really well done in 10 pages. Don't send me 100. Don't send me 50. I don't have time for that. And
Right.
for those people that are older like me, you remember the phrase about the P&G 1-page memo. I think that's gone by the wayside, but the premise of it was being really focused is hard. It makes you make tough choices in what you're telling people. It's really easy to write a 100-page Word document. You just keep spouting off. But there's a lot of confusion because any preconceived idea you have is buried in that 100 pages, as opposed to if it's a short document, you got to tell me what I really need to know. So those are my 5 things to tell investors.
Great advice, Andy. Great advice.
Yeah, I think I just used up all the ink in my pen taking notes there. So I will say that one of my first really great managers that I was fortunate to have was a Proctor guy. And I did become the king, Andy, of a 6-point font with no margins on my 1 page. But damn it, I was down to 1 page, brother.
Yeah, no, I mean, there's something to be said for that. And I'll never forget the first time I wrote a PowerPoint. I don't think we had PowerPoint, but PowerPoint presentation. And my boss showed me what a horrible document it was because it didn't tell the important things. It left out this, it missed that, and it was confusing. And there's
Thank you, sir. May I have another?
Exactly.
So Andy,
Yeah.
kind of rolling on this
Yeah.
thing here. What mistakes would you tell a brand or the founders to avoid when approaching investors? I think you've probably said it in the various examples you've given, but to paraphrase and then you can fix it. Don't bring me 100 pages. Don't camouflage your numbers. I'm not asking you for, the congressional budget, if we even have one anymore, but here's your short P&L, here's your key line items. What other things, what mistakes might a founder make, or what should they be bringing forward? Don't hide stuff. We had retailers come on our show and they say, one of the big mistakes brands make is they hope we won't see stuff in the data, but we will.
Yeah, no, I think that's right. Let me give a few random thoughts and maybe I'll go deeper on 1 or 2. A few random thoughts. Don't think that most investors move faster than they really will. They're moving at their pace, not yours.
Yeah.
And it takes time. People are busy. That's one. Be careful about believing your own press releases. There's a fine lines between confidence, which everybody wants to see, and cockiness, which nobody wants to see. Don't focus too much on valuation. But when somebody asks you what's your valuation expectation, don't say, I'll let the market tell me.
Oh, gosh.
Because somebody is going to say, great, terrific. When you figure it out, call me and hang up on you.
Yeah.
If somebody asks you a direct question, you need to have a direct answer. And that's one You should have an expectation. Hopefully it's realistic. So, I mean, those are some sort of quick rapid fires. But at the end of the day, I mean, the biggest ones are people are investing in the future of the business and you as an entrepreneur. As a result, everybody is going to give your projections a haircut. Everybody. The question is, do they give it a 10% haircut or an 80% haircut? And that will be based on their confidence in you and the documents you share. You know, when I see businesses, let me give an example or two. All right. So when I see businesses that have a very rational $500,000, million, $1.75 million, and then they're projecting 2.5 and then 117. I'm like, where did that come from?
Right.
So, you know, the irrational stuff doesn't bode well. You know, we're at 25% gross margin today, which by the way is a real problem, and we're going to get to 55% in 2 years. How are you going to get there? Scale. Oh, that's my favorite answer. Businesses do not pick up gross margin because of scale. They pick up margin because of hard work.
Yeah.
Eliminating non-value added costs. You know, working harder on, you know, making your 7-color graphics work in 4 or 5 color, which saves a ton of money on your printing. Lightweighting your bulletproof cardboard without sacrificing compression strength. I mean, all this stuff takes a lot of hard work, but that's where the magic happens in margin. So, you know, I very politely sometimes step on the BS button when I see the 25 to 55 kind of projections. I generally don't believe that. But you know, those are all in the buckets around, you know, be realistic. But it's I admit full bore, it's hard for entrepreneurs because they want to show excitement, huge numbers. They also want to show reality, like what's achievable. And I get that there's natural tension. Mm-hmm. So the obvious question I get from a lot of entrepreneurs is, what do you do about that situation? And my answer is, show 2 lines on your graph. Here's our history. That gets me to here. Now going from here, I go to here. That I know we can do. And here's the 3 key assumptions. If these 3 things happen, we go to there. Okay. You got a solid line of here's what the base plan is, and here's the upside plan. That's okay.
Right.
That works. But, you know, you got to answer people's questions. You got to give them a sense of confidence. But at the end of the day, just don't overthink it.
Yep.
That's awesome. I love it. I love it. So we've talked about mistakes. So tell us, maybe give us an example or two of the brands or entrepreneurs that have done it right.
I mean, there are plenty of examples of people that have done it right, both in big ways and in small ways. But at the end of the day, it's a compelling story that shows the reason to believe. Whether you're an online CPG business or a retail CPG business, or in most cases both, you're going to have some data, assuming that you're in the market already. And you need to think about, what's the money chart? What's the one that's going to get you the money? And there are a couple examples in the resource section, but you know, if you have teeny little distribution, but a velocity, you know, some sort of sales per point of distribution or dollars per ACV or units per store per week, some sort of a same store sales metric that is killer, not just growing, but comparatively pretty towering versus existing brands, That's pretty damn compelling chart.
Hmm.
You know, I got 4% distribution, but we outsell the leading national brand in those 4%, 2-1. That's pretty compelling. You'll get more distribution. You might get some money out of it. Every business has some version of a compelling data story. You know, food is a fine margin category, but food doesn't tend to have 30 and 40% true gross margins if you do it on a GAAP basis. I've had the privilege to be involved in multiple businesses, food businesses, with gross margins materially over 50. That's a pretty damn compelling story, and it's a different version of the money chart.
Right.
So, you know, finding the compelling story is helpful. The other thing is, the earlier the stage you are, the more important it is to have some credibility in your investor base. There are lots of people that want to follow somebody experienced.
Right.
So it doesn't even have to be a household name, but if you're in the meat business and a retired top 10 executive at Tyson or ConAgra or Oscar Mayer personally invests $100,000, $50,000, that means a lot to people that don't get your space. So be strategic about your choices and investors, because nobody wants to be first.
Right.
I owe a huge debt of gratitude to the first large investor that invested in my first fund. And it was two families that often invest together. And they were material investors in our first fund, and they were the first recommit in fund 2 and the first recommit in fund 3. I am very appreciative, but others followed.
Yeah, having the people that have you know, experience and credibility in the space kind of pull in others because they think the road is paved and they're like, that guy knows what he's doing, or that gal. All right, Andy. So as we head toward home plate here, couple of quick ones for you, rapid fire. And because this is live TV, here's a question we're hitting you cold with.
Sure.
Who is somebody who had a great influence on your career? You can either name names if you want, or you can just say, hey, this manager did this and I've never forgotten it. But who really was a positive influence in your career somewhere along the line here?
Yeah, there are probably two most notable. One was I had the privilege of being hired into a group at General Foods, and that group, you know, General Foods doesn't exist anymore, bought Kraft, as I said, but the woman that hired me ended up to go on to become a very successful CPG industry CEO, and I worked for her a couple times and learned a ton. And when she took me aside and said, hey, there's this great opportunity I think you should think about taking, which in corporate America sometimes is a euphemism for the decision's already made and the announcement is going out while I'm talking to you. Mm-hmm. I didn't understand why this was a good job. And quite frankly, I thought I was being shot. And she was right. It was the best assignment of my career. And it gave me a cross-functional background that I never would have gotten otherwise. As a pretty young guy, I ended up with some manufacturing experience and some sales experience. I started as a marketing kid, and it was the best assignment. Then later in life, I got a chance inside of corporate America to know a couple of the private equity guys that invest in CPG. And I have tremendous admiration for all three of the firms that I met inside of Kraft that were sort of the three marquee names, all three which still exist today. You know, one of which is now called L. Catterton, one of which is now called TSG, and one of which is Swander Pace. Those were really the three marquee firms 25 years ago. There weren't a lot of other consumer-focused investors of big sort of profile. All three very successful. All three still exist.
Yeah, they're still doing good work.
still doing really good stuff. And there's some other great firms that have joined them. And one of the partners I got a chance to work with on one of my first investments, and I learned a ton from. So both from the CPG operator standpoint, the smartest person I've ever met, and the private equity world, I was privileged to get a chance to get to know some great people and learn from them. And I hope to be able to give that back.
So Andy, thank you very much for that.
Sure.
People have always helped. People help everyone along the way. And if you ever think you did it all yourself, man, I probably don't want to work with you. How can people get in touch with you? I mean, you guys have a bunch of resources on your website that I think people might want to check out, but what's the best way for someone to chase down Andy Whitman?
Sure. I mean, they can reach for me at Andy at Loft Partners, loftgrowthpartners.com. But candidly, we've been around long enough, and I've been doing this long enough that sure, people can email me out of the blue, but that doesn't demonstrate a lot of resourcefulness. And, I'm getting, I don't know, 1,500 emails a week, probably more. It could easily get lost in there. But it's not very hard to find somebody well that knows me. That's a much better idea. I'm much more interested in something, hey, Bruce said you should take a look at this. Would you give him 30 minutes, or, would you take a look at his deck and give him feedback? Sure, I'm much more likely to do that for Bruce than for a random email inquiry. I love when I get random emails. My name is so-and-so. I'd like to schedule an hour or two of your time. Yeah, I don't think so.
Yeah, the warm intro counts for something, and relationships still matter. So
it does.
So Andy, before we roll into the big finish that Tracy leads, thank you so much for coming on the show. This has been absolutely magnificent. Tracy, take us home, baby.
Absolutely. Andy, thank you so much for joining us today. Great insight. Love it. Thank you.
My pleasure.
Thank you for the resources. And thank you, audience, for joining us today. Please continue to follow us on Spotify and iTunes under Road 2 Retail, and look for this episode as we post it on our LinkedIn page. But thanks, everybody, for joining us today.
Good luck out there.
Take care.